Hi guys, hope you are doing well. So in this video, we are going to look about a Indian footwear manufacturer called Bata India. So before going on to this video, I need to make some points very clear. Please do not construe this video for your investment purpose, and I will not be responsible for any of your losses. The reason why I am making this video is I just wanted to share my research and learnings on this specific company called Bata. So once again, I'm telling you, please do not make any investment decisions out of this, and I will not be responsible for your losses. So let's straight away jump into the video. So we will be looking at a footwear manufacturing company called Bata India. So many of you may be aware of that company. So we'll just straight away start with the company overview. So Bata India is India's largest footwear retailer with a diverse brand portfolio. So this company is well positioned to benefit from the growing footwear market, and it is actively working to resolve this historical issue. And this forecasting thing that have been done in the video is purely based on my knowledge about this company and the industry, and purely my point of view. So it may or may not happen. So I am expecting the financial performance of Bata to be 11% revenue growth and 27% PAT growth over financial 25 to 27. And let's look at their business model. So Bata India is the India's largest footwear retailer. They operate over a vast network of stores, close to 1,900 stores. And Bata India offers a wide range of brands across multiple price points and multiple gender categories. So it has footwear for women, children, kids, and men's. So in terms of channel mix, the company has a strong presence in brand outlets. They are operating both at MBOs, multi-brand outlets, and as well as EBOs, exclusive brand outlets. So Bata India is well positioned to benefit from the medium-term opportunity in the footwear industry. So what are all the growth catalysts that you have to look at Bata is the key management change, the appointment of Mr. Kunjan Shah. So he was appointed in back in 2021 as a chief executive officer for Bata, and he has brought various changes to the company. And Bata has been actively addressing its legacy issues by focusing on expanding its distribution network and increasing focusing on the recent trends like sneakers and casual footwears, and their ad spends have been low very compared to their peers, so they have boosted up the ad spends, and the list goes on. We'll see at the later part of the video. So and the other main thing for the growth catalyst is stabilizing its value segment. So value segment in the sense price of the products below rupees 1,000. So there are signs that this segment is also stabilizing, and so based on the above growth catalyst thing, I think for FY 20 to 25 has actually contracted by 5.5 percentage. So based on many reasons, we'll discuss at the later part of the video. And yeah, so apart from that, there are multiple growth levers. The company is focusing on premiumization, and it is focusing on asset light models such as FOFO model called as franchisee owned franchisee operated. And the next thing, we'll just look at a snapshot of our investment thesis. So the fir- first half of FY 25 was very subdued for the Indian footwear segment, and I think the whole financial year 25 will be subdued. It will also translate into an decreased EBITDA. So there are early signs of recovery in the value consumption segment. So this will improve their sales. So ultimately, their EBITDA margin will expand during financial 26 and 27. So that is why I came to one conclusion that forecasting 11% growth rate and EBITDA margin improvement of close to 3%. So this will give us an PAT growth of 27%. So we'll start with a snapshot of company overview and their history. So Bata holds the top spot as the India's largest footwear retailer, and they have a network up to like 1,900 stores across the country that has their products span across multiple price points and multiple products. So in addition to its own brand, Bata also has multiple brand. For example, it has its local Bata brands and it has international types such as local brand is Power, Comfort, North Star, and it also has licensing agreements with international brands such as Hush Puppies, Natural Laser, Doctor's Calls, and Nine West. So we'll just look at what are these brands. It come does this come under premium portion or Bata brand in the later part of the video. So let's just look at the history of Bata. So you may have already known that Bata is not an Indian company. It is a Czechoslovakia based company. So their entry into India by using their own brands Bata, Power, and Comfort. So they are mostly an EBO network. So they are mostly dominant on their own exclusive brand outlets, and they have close to 1,900 stores with 3.7 million square feet of rental area. So apart from this, beyond exclusive brand outlets, they are also operating on omni-channel mix. Example, e-commerce. It has three manufacturing plants in India to ensure local production capabilities. Let's just look at some data on Bata India. So in the channel mix, 70% of the revenue comes from its company one company operator model, and 8% comes close to franchisee one franchisee operator model. So that gives us the exclusive brand outlet contribute above close to 80% of the total revenue. So in terms of category mix, casual footwear dominate the segment with 32% of the revenue. Up next is formal thing. So up next is formal thing. So the next the stuff is we have sneakers and footwear. So the casual footwear and sneakers comprises about 55% of the Bata's revenue. So in terms of gender category, we have 45% of the revenue from men and 33% from women. So men footwear contributes more revenue to Bata. If you are talking about MRP wise sales, products that are very premium. So let's say for example greater than rupees 2000, contributes about 25 percentage, and the most dominant uh, price range is 1000 to 2000 rupees. That comes about 35 percentage, and the remaining is 500 to 1000 and less than 1000. So almost 40 percentage of the Bata sales pertains to price below rupees 1000. So this is considered as a value segment, the price range below 1000. So this has affected a lot, and it is also one of the reasons why footwear is not performing well. So if you look at brands alliance, their own brand Bata, uh, it contributes about 40 percentage of the revenue, and we have Hush Puppies, Power, Comfort, and various brands. So let's start looking about Bata's brand positioning in management. Let's start with Bata's brand. So Bata has various brands. I just categorized it as is it a Bata brand or what is the price portion. So uh, you just look at it, it is a yes or no, and or it is a mid or premium. So I just don't have to repeat it every time. So first, they have their own brand Bata. So it is spanning across multiple categories at multiple price points. Hush Puppies, you may have known, it is a premium product. It is actually an American brand owned by Wolverine Worldwide. And Power, it is a Bata brand, and it is focused on sports and athleisure. So launched by Bata in 1972. Comfort, it is also a Bata brand focused on mid positioning. So it is focused on comfort and comfort focused brand. Likewise, Floats, yes, it is a Bata brand mid price positioning. Plus, it's a casual footwear brand. Red Label, the same thing, but it focuses on style and quality. So the same with the North Star. North Star, it's focused on children's footwear. Weinbrenner, it is a travel footwear. So Naturalizer, it is an international brand. Bata has a licensing agreement with them. So it falls under the premium category. It is a premium women's footwear. So it is owned by Calories and Corporation. You may have known the company. So Doctor's Call, it is not a Bata brand, but it is focusing on the orthopedic footwear brand. The next thing is Mary Clary. So it is a women's footwear brand, and the last thing is Nine West. So Nine West, it is a premium footwear brand. It not only offers premium footwear, it also offers bags, watches, etc. etc. So we'll just look at the Bata's management. Let's start with the company's chairman and independent director, Mr. Ashwin Windlass. So he has a very rich experience for working for global giants like Hutchison Group and British Telecom and Hitachi. So Hutchison, Max, you may have known that it is now the Vodafone India, and the managing director and CEO of the Bata India, Mr. Gunjan Shah. So he was the chief commercial officer at Britannia Industries prior to joining Bata. So prior to joining Bata, he was working at various roles like commercial operations, sales, marketing, and supply chain management on various companies like various giants like Asian Paints and Motorola. So the next person is Mr. Badri Periwal. He is the Chief Strategy and Business Development Officer. So his notable leadership, he has very notable senior leadership positions, including Chief Marketing Officer at Viba and Marketing Head at Stanley Black and Decker. So his most notable experience is his various roles at Walmart and GSK Consumer Healthcare India. So the next person we are going to look at is Ankur Rastogi. So he is the head of the product department. So he also has held various senior positions like SSIPL Retails and Lakhani India. And the head of the supply chain management is Mr. Anjan Kundu. So he has held various senior position at Henkel India. So Henkel India is German MNC focusing on abrasives and Hindustan Unilever and Coca-Cola company. So he joined in Bata at 2022. The last person in this list is Miss Pooja Minoka. So she is the head of the human resource development, and she joined Bata in 2022. Her previous employer include various life insurance and pharma companies. So overall, Bata's management is quite very good, and the board of the members has a very good experience at various global MNCs. So let's straight away jump into our investment thesis. So we'll just start with the revenue growth. Like, so what happened with Bata? So why are they underperforming compared to their peers? So Bata's revenue growth in the past 5 years, between the COVID-19 was notably very slow. As you can see this graph. Sorry, this graph is the bar graph is inversely done, but you can see it right here. So as you can see from financially 16 to 20, so I just compared Bata with its peers such as Relaxo and Metro. So Bata, it is underperforming every year compared to Relaxo and Metro. It has only achieved a revenue growth rate of 7% during this period. So this sluggish growth indicates a lack of market share gains, and it failed to capitalize various key opportunities. And the next thing is limited store expansion. So during this period, Bata has not expanded its retail network very effectively. The number of store increased from financial year 16 to 20. So it is close to 1,000 to 80. Now it is now FY20 it is 1,500 stores. That translates to 5% growth between every year. And in terms of and in absolute terms, in terms of store size in million square feet. So in 2007 FY17, it had 2.85 million square feet of rental area, and in FY20 it has 3.25. So that is a CAGR growth rate of 5%. So this limited expansion have restricted the company's reach and market penetration. So it is a competitive landscape. So slow response to market trends and missing out on growth opportunities. So this footwear market, as you have personally witnessed, it is shifting towards premiumization and casualization, and mostly collectively called as sneakerization. So despite having the diverse product portfolio, Bata failed to capitalize this growth. So, like to say, even though they have the products, they fail to leverage these as assets to cater to the evolving consumer preferences, mostly to sneakerization. So, in terms of brand building, Bata is underinvested during these years. I have just compared Bata with its peers on ad spend as a percentage of sales. As you can see, its peers Relaxo and Metro, they have huge amount of ad spends like 3 to 4 percentage, whereas Bata it's lagging between 1 to 2 percentage. Straight away in the FY 19 and 20, they just have improved their ad sales. So typically, the ad spends as a percentage of sales was below 2% for Bata. So this underinvestment may have likely to be a weaker brand image and lower brand equity. So these are all the reasons why Bata has struggled just to improve their revenue. So the next investment thesis is so Bata's a strategic shift. Trying to focus on growth and modernization. So how Bata is going to do it by expanding the distribution network. So what are all the modes of distribution network they have? So they predominantly have EBOs and MBOs. So in terms of EBO, which is an exclusive brand outlet, so Bata is focusing on rather than it is focusing on enhancing the overall reach rather than rapid expansion. So there is a steady growth in EBO expansion for Bata between financial 20 and 24. So if you look at the number of uh, franchisee operated stores that they have opened in financial 19, they had close to 140 FOA4 stores, and in FY 24, it has 530 stores. So it is a very good thing. Primarily, this is focused on tier 3 towns. So apart from the urban areas, rural area, the spending is happening very good. So that if you see the town coverage, how much better it's covering in financial 19, they had close to 687 towns, and it almost doubled its thing. So in FY 24, they have 1538 towns covered. So if you look at the weighted distribution of MBO coverage, so Bata covers 46% of the total MBO network. I hope you know how weighted distribution works. So how this works in multi-brand outlets. Uh, so usually in a multi-brand outlet, not only Beta's products will be there. So the products of Relaxo will be there. The products of Metro also will be there. So based on the store size and the sales out of the store on how much Beta is selling. So with that data, we just have I have done a weighted distribution with it. So Beta covers 46% of the total MBO network. So I have previously talked about how Beta failed to capitalize the new trends based on sneakerization. So in financial year 22, they launched a wide range of sneakers across Bata brands. So if you look at, you may have known a shop called Sneaker Studio. So this specifically for Bata sneakers. So in FY 22, the sneaker stores count was just 15. In FY 25, it has 739 stores. It has grown a very good. So if you look at the casual footwear thing, so in FY 22, they launched a brand called Floats. It is a casual and comfortable open footwear. So they opened various kiosks in FY 24. I hope you guys know what a kiosk means. It is nothing but a small size store, shifting product mix. So uh, casual and sneaker accounts for 50 to 55% of the total revenue. So in financial 19, the casual and sneaker footwear contributes about 35%. Now it accounts for 55%. So that represents how much? It's a 20% growth, increased ad spends. So as you have previously said, how Bata is under investment in terms of brand building. So it has also improved very much. As you can see, the average ad spend of 2.6% in past 3 years. Next thing we are going to look at is our third investment thesis. Bata's value segment. What are the challenges it faced and its potential recovery? So, what happened in the decline? So, what are all the reasons that led to a decline in the value segment? The first thing is what are the value segments? The product priced below rupees 1000 are considered as value segment. So the contribution of products below 1000 has reduced from 50% in FY19 to 40% in FY24. So what are all the reasons for this reduction in this value segment? It is because due to unemployment, subdued income, growth and inflation, it may have negatively impacted the consumer spending, especially in the value segment, and increased the GST rates. They have increased the GST rates of products below rupees 1000 and footwear for 5% to 12 percentage. So this has further pressured this value segment. So I am seeing signs of stabilization and potential recovery in this value segment because if you see the FMCG volume growth trends, so in first quarter of FY24 it was just 3%. In the first quarter of FY25 it was close to 5%. And if we look at the consumer price index inflation on year basis, on August 23 it was at the high. It was like 7%. In August 24 it is close to 4%. So the inflation is also CPI inflation also coming down. We have FMCG volume growth happening. And if you just look at the MNREGA jobs, you may have known that the 100-day wage jobs. So it is actually reducing, which is a very good thing because people are shifting from MNREGA jobs to various jobs at private sector. So it will for sure boost the economy and the spending. So these are all the things that will these are all the signs of stabilization and potential recovery in the value segment. So let's discuss about our fourth and last investment thesis. So what are all the strategies that Bata is doing now for its margin improvement? So the first thing is premiumization. So the contribution of products priced above rupees 1000 has increased from 50% in financial 19 to approx 60%. So this is premiumization, and as the income level increases, of course the demand for the premium products is expected to grow further. So Bata's diverse range of premium brands and categories, it keeps it as a good position to capitalize on the spread. Let's just look at various Bata's premium category brands and its average selling price. If you look at sneakers, the average selling price is rupees 2000. In Hush Puppies, the average selling price is 4000. In Floats, it is 1400, and in Comfort, it is 2100 rupees. So, what are all the challenges, operational challenges that Bata is going to do? So, if you are trying to improve your EBITDA margins, there are multiple ways, but the most two common ways is uh, improving your product mix so you can get a better margins, or improving your operation efficiencies. So you are just cutting down unwanted expenses to just improve your margins. So we have discussed the product mix for margin expansion, and we'll just discuss about their operational changes on a margin expansion. Here I have done an EBITDA margin work on how much is the gross margins and how much everything is subtracted and how we arrived at an EBITDA margins. For a company like Bata, a footwear industry, the the EBITDA margin heavyweights are employee expenses and rental expenses. So these are all the spaces. These are all the place that we have to focus if you are focusing for EBITDA margin expansion. So Bata is taking steps to reduce the impact of subdued sales on growth cost. So this is nothing but negative operating leverage. So you might have known about operating leverage, or just let me explain it very shortly. So for a company like Bata, in order to improve your sales growth, they plan on opening up new shops on multiple locations. So the more shops you own, the more sales you can do. So the more profit you can generate for your shareholders. But it comes with the cost of fixed cost. The more shops you own, the more fixed cost you have to incur. If or not sales happens or not, you still have to incur those fixed cost. If sales is happening, it is good. If sales is not happening, you have to incur those fixed costs which will eat up those profits. So this is how operating leverage works. So the company is implementing. So let's just start with their employee expenses. So as of FY19, it is 11.3 percentage. In FY24, it's 12 percentage. So the company is implementing flexible workforce strategies and the performance-based incentives to control labor cost. So employee cost has increased by 0.3 percentage, sorry, 0.7 percentage between these 5 years. But it is expected to moderate as sales recovers. So operating leverage can be a double-edged sword. It is based on how the sales is performing. So managing royalty rates. So Bata is managing royalty rates. Make sure they align with the growth. If you look at the royalty rate, it is 1.5 percentage. So now it is 2.5, 2.3 percentage, a 0.8% growth. So streamlining IT cost. So hiring and implementing various IT thing will also improve your technical fee. If you see the technical fee in FY19, it is 1 percentage. So now it is 1.4 percentage. So these are all the factors that we have to look at. So how Bata is addressing its operational challenges. Uh, Now this comes under the rent category. So accelerate the store expansion. So Bata plans to add approximately 180 to 200 stores on one franchisee operated model. It is a asset light model. Company one, company operated Coco model is a asset heavy model because you are spending money on fixed assets, so you can have more profit. In a franchisee operator model, you are just giving permission for the franchisee, so he will take care of the fixed costs such as land acquisition, rent, and the labor expenses. So this will improve your return on investment. So the major enhancement that you have to look at is this FOFO model contributes to a higher EBITDA margins due to reduced operate cost. Your franchisee will take care of the fixed cost and increased market reach. So giving your franchisee to everyone, you don't have to directly involve in opening the shops. Your franchisee will open various shops on tier 3 and tier 4 cities. So Bata had a target of achieving its 500 FOFO stores on FY25, but it has achieved a year prior to this 533. If you look at FY19, the FOFO stores are close to 140. So now it is 533. So the target was 500 stores on FY25, but they have achieved a year prior to this. So if you also look at the historical data on company owned, company operated, and franchisee owned, company operated, in FY19, 90% of the mix was dominated by company owned, company operated, and it has reduced uh, to 71%. And in FY19, the FOCO model was 10%. So now it is 29%. With respect to the management's data and opening up 180 to 200 stores per year, with 80% of that being a FOCO model, I expect this ratio to come down and this ratio to go up. So with all these things, so how Bata is going to leverage its operation efficiencies. So Bata is shifting into a satellite model. They are just closing down its various manufacturing facilities and various warehouses, and hiring third party logistics and third party warehouses for their rental storage and thing. So this will improve their operation efficiency. And in terms of uh, digital transformation, they have implementing various IT initiatives like HPM and the ERP. So this will improve your cost efficiencies. So as of now, Bata is Bata's operating margins is 13%. I expect a dip in FY25 to 11%, and once the sales recovers, the possibility of positive operating leverages will happen, and in FY26 and 27, it will reach to 14%. So this is what I have mentioned here for the forecasting thing. So up to this point, we have seen our 4 investment thesis on how Bata is was doing in the past, and what are all the challenges it has faced. So now based on our assumption, let's start forecasting its financial. Let's straight away start with its revenue growth. So before forecasting, let's see historical performance of revenue growth of Bata. So in FY 17 to 24, Bata's top line growth, which is revenue growth, has been subdued. It has grown at close to 5% during FY 17 to 24. So because due to volume stagnation. So if you see the volume growth of if you see the volume growth of Bata in FY 17, they have sold over 48 million pairs of footwear. So if you just look at FY 24, it has actually reduced 46%. It is due to the we have previously seen that the value segment is largely affected. But if you see the average realization price, it has gone up. So in FY 17, it is 500 rupees for the average selling price. Now it is 760. That is also a bad thing and a good thing about this. The volumes have not grown because the value segment have affected. But we can also take this point as the value segment has not grown because people are preferring more premium products. So that is why the average selling price have gone up. So if you look at the average realization growth, after before COVID, there was not much growth, but after COVID, you can see it is growing up to 17%, 14%. Now it has reduced. So if you look at year-on-year growth in volume, so it is also has a stagnated in FY 24. Here is the reason. So due to subdued mass demand, which is value segment, uh, a shift away from high volume, low margin categories like Hawaii slippers. So Bata experiences volume growth. So the next thing is our forecasting. So I am forecasting 3% revenue growth in FY 25 for Bata, which is due to gradual recovery in consumer segment. For FY 26 and 27, I am expecting a huge growth, a double digit growth, because my assumptions are Bata is focusing on franchisee one franchisee operator model. Uh, it is mostly based on tier 3 cities where the rural growth is higher than the urban growth. So it will drive the sales and plus e-commerce plus premiumization. So this will translate into 11% growth for FY 26 to 27. In terms of absolute revenue growth, Bata it is now currently making 3479 crores. So in FY 25 it will go up to 4700 crores. So that's it. I am expecting a gradual recovery in financial 26 and 27 of 11%. So if you look at financial and forecasting too, here we are going to do forecasting on margin analysis. So we're going to forecast gross margins, EBITDA margins. If you are breaking down EBITDA margins, we are going to focus on employee expenses, rent, and ad spends. Let's just straight away start with the gross margins. So historically, gross margins of Bata has experienced expansion. If you look at it is 52% in FY 16. So it is now a 5% expansion, close to 5%, 57%. So this gross margin from FY 21 to 24 has remained relatively stable. This expansion is particularly due to premiumization. The value segment has not performed well, but the average selling price here we can see the average selling price has gone up. So Bata has been able to generate more gross margins. But this effect of premiumization has been subdued by various various things such as raw material inflation and the higher GST thing. So this will not hinder the gross margin, but I am expecting this gross margin to be stable around 57% for the next 3 years. In terms of absolute gross profit, Data is doing close to 2000 crores. I am expecting 2700 crores in gross profit. And in terms of year on year growth, I am expecting the same as revenue growth, close to 11%. So the next thing is, let's just discuss about EBITDA margins. If you have seen the historical performance of EBITDA margins of Beta, it has expanded by 5% between FY 16 to 20. So this is because due to in this period, gross margins have also expanded by 5%. So this EBITDA expansion was a translation from its gross margins. So in recent trends between FY20 to 24, the EBITDA margins have come down. If you look at FY16, the EBITDA margin was 11%. In FY20, it was like 16%, a 5% expansion. So now it is earning around less than 3% have been negative. So it is 13%. So to address this, so what are all the reasons why Bata is EBITDA margins have been performing well for finance 16 to 20, and why it has a subpar performance? Because due to negative operating leverage. I have previously told you that for a company like Bata, in order to do more sales, we have to open more shops. So if you are going with company owned company operated model, you have to incur those fixed costs. If your sales is not doing good, your fixed costs will eat up all those margins. So this is what is at it has a negative operating leverage, and they have hired various IT firms to improve their operation expenses. So let's just look at what are all the key cost drivers of Bata. The first key cost is employee expenses. So the company is focusing on expanding its franchisee one franchisee operated model. So this will directly reduce the company's employee cost because your franchisee will take care of the hiring and the land acquisition process. And even with the company one company operated thing, the Bata has implemented flexible manpower scheme. So this will help you optimize labor cost. And for manufacturing, outsourcing, and warehousing thing, so this comes under the rent thing. So if you are not owning any manufacturing facility or logistic things, you don't have to incur any of those fixed costs because you are just renting it out now. So you understand this thing. So my outlook on EBITDA margins is it is expected to moderate as the sales expected to moderate in FY25. So EBITDA margins will likely to improve. So here it is. If you look at the rental cost as a percentage of sales, you can see it is like 14% in FY16. It has peaked out in financial 21, and I am expecting a gradual recovery in this thing to 12%. So in terms of EBITDA margin, I am expecting a slight dip in FY25 and expecting a gradual recovery of 12 to 14% in FY24 to 27. So this is what I have given here. As you can see, the employee cost as a percentage of sales, it will slightly rise up in 13% as the sales picks up, and it turns out to be a positive operating leverage. Employee cost will come down. So it is the absolute terms of employee cost. So the next thing we are going to forecast is Beta's net working capital. So let's just look at some historical data on this thing. So Beta's working capital in financial 24, the net working capital days was 69, which is higher than the 10-year average of 57 days. The most working capital components is their inventory, so 98 days in FY24. So the largest component of working capital is their finished goods, which is nothing but the inventory held at their retail stores. The receivables are very low, even though the inventory days is very high. The receivable days are very low because Bata at that period of time focusing on company one company operator stores. So you are not directly lending out your products to anyone. So you are spending on your own stores, so that receivables will be very low because 70% of the revenues are from your company one company operator stores. So that leads to a direct sale into customers. And you can ask that Beta has been focusing on opening up various opening up franchisee one franchisee operator stores. So it may increase your receivable days, but that will not actually happen because FOFO stores are primarily carried on cash and carry basis. So if you just look at creditor days, it has sharply moderated to 60 days to 31 days because company is as you can see, it is a cash and carry basis for even for a franchisee one franchisee operator model. These are just basic things like other current assets and liabilities and working capital. So I am forecasting the working capital for Bata to be stable at 65 days. So I will just share the link of the sheet. You just have guys have a look at it. So let's just look at Bata's fixed asset and capex. So Bata currently operates at three manufacturing facilities: Bata Nagar in Kolkata and Partner Hosur in Tamil Nadu. So in financial year 17, the company has closed its manufacturing unit in Faridabad, Haryana, and it has recently announcing its closure on the unit in Bengaluru. So what will happen is you don't actually holding your assets. So okay, that is what Bata is trying to become an asset light model. So more assets you own, the more fixed cost you have to incur. So if you are not making very good profits, your return ratios will be affected as well as your fixed asset turnover ratios will also be affected. So Bata is before a dominant in-house manufacturing thing. So if you just look at here, the in-house manufacturing percentage of Bata has been decreased from 35% to 25%. So what this means is they are not holding various fixed assets. They are trying to become an asset light model. So their fixed assets turnover ratio will be very good. From FY21, you can see that the fixed asset turnover ratio has gone very up big. This is because due to it has closed various manufacturing facilities and the company has been moderating its COCO model and focusing on FOCO model. So you are not holding up any assets. With the upcoming franchisee owned franchisee operator model, I am expecting this ratio to go up. As we look at the capex and the percentage of sales of Beta, it has moderated at 1.7 to 2.6 percentage, and currently we are at 2.7 percentage. As the company is moving towards the franchisee one franchisee operator model, they do not have to incur any additional capex for this. So I am expecting this capex to sales ratio to be moderated, just 2.7 percentage. The next thing we are going to look at this it's cash flow thing. So over the past 8 years, Bata has accumulated a free cash flow of close to 1,000 crores. Uh, so even with so Bata has generated close to 65 percentage of free cash flow as a percentage to PAT. So it is a very good metric. So even with I just excluded the COVID affected years, FY21 and 22, and I just calculated the based on it. So I am expecting FY25 the free cash flow generation to be 93 percentage of PAT. This is supported by a slight reduction in working capital. As you can see, I have Data currently has 69 days in net working capital. I have forecasted it to 65 days. So your overall things will improve. Your overall working capital will improve. So in terms of net cash levels, it has shown a steady improvement. I just have excluded the FY21 and 22. So in FY23, even with a significantly heavy dividend payout, they have maintained the good cash levels, arrived at the free cash flow and free cash flow to the film. Hope you guys know difference about free cash flow and free cash flow to the film. Okay, I'll just explain it anyway. So free cash flow is nothing but when cash uh, left for the company after every expenses. So free cash flow to the firm is cash available for the equity shareholders after company's every expenses. So based on this free cash flow to the firm, the company may decide to buy back shares or rewards its shareholders for dividends and things etc. So if you look at the return ratios, we look at capital return on capital employed and return on equity. So in FY16 to 20, the return on capital employed was improved from 15% to 28%. So the primary reason for this thing is it was driven by EBITDA margin expansion. Here you can see EBITDA margin was 11 percentage. So in FY20 it was 16 percentage. So it is at 5 percentage growth. So this has translated into a good ROIC. So I am expecting a dip in FY25 due to negative sales, and once sales start kicking, the same thing will happen. The EBITDA margin has been expanded between this period, and EBITDA margin is going to expand in FY26 to 27, and I am expecting a good improvement in ROCE. So this is what I think it may happen. Okay, we have completed our investment thesis and forecasting. Let's just discuss its valuation thing. So let's just discuss on my key assumption on Bata India's valuation. Let's just start from the beginning. So Bata, it is a leading footwear player in India. It operates at various price points and various categories. Uh, while the historical revenue growth has been challenging, the company is implementing various strategies to accelerate growth, which is expanding retail network by focusing on franchisee owned franchisee operated in tier 3 cities where tier 3 in the rural areas growth is higher than the urban areas, and adapting to new market trends such as focusing on casual plus sneaker style to meet the evolving consumer preferences. And Data has also stepped up with advertising and marketing spend. Furthermore, there are several factors that will actually improve its EBITDA margins in the medium term, which is premiumization, which is evident that in FI 16 to 20, their EBITDA, their gross margins have also improved, which in turn improved into a good EBITDA margins, and focusing on asset light models such as franchisee owned store. So this premiumization is change in their product mix. So this will work as a incremental EBITDA margin. So this franchisee focus is focusing on asset light model. So this is premiumization, like you are just having a product worth of 10% margins. So you are selling it at a premium price, so you will get a 12% margin. You are getting incremental margins. So if you are in franchisee focus, you are just cutting down additional costs such as rent and labor cost. So this is how it will operate. In increasing operational efficiency, you are just implementing various IT projects and like ERP and HPM, enterprise resource planning, and HPM. It will increase your operational efficiency, and outsourcing non-core operations, just shutting down many plants and using third-party services for warehouse renting and logistics. So it will bring down your cost. So this is how Bata is going to improve its EBITDA margins. So before going to our performance outlook, let's just have a look at what are all the past challenges Beta has faced and what are all the steps it has taken to address the past challenges. So limited store investment, it has translated to only 5% expansion between FY 16 to 20. The retail area expansion as of 22 FY 22 to 24 has been accelerated close to 9.5%. So this is mainly from FOFO model, franchisee expansion. So these stores have grown at the 220 stores in FY 25 to close to 533 stores. They have a target of 500 stores in FY 25, but they have achieved a year prior to this. So additional to this, company has renovated 50% of its store in the past 3 years. So okay, uh, let's just look at our second past challenges for that. So slow response to the evolving consumer trends such as casual footwear and sneakers. So the mix of casual and sneaker portfolio has increased from 35% in FY 19 to 50 to 55% now. So that translates to a growth rate of 11 to 13% in this portfolio. So the third thing is under investment in the brand building. So the advertising spends as a percentage of sales has increased from just a mere 1% to 2.5% between financially 17 to currently. So they have also launched various trendy ad campaigns such as to attract young audiences. The value segment was facing pressure due to increased GST rates and inflationary pressure. So the products below rupees 1000 has decreased from 50% to 40%. There are good things and bad things about this one. So they have reduced the value segment contribution and just focused on premiumization. So that has actually been a very good thing for them. So it translated to cross margin expansion, which ultimately translated their EBITDA margins. But in this value segment, as of now, there are initial signs such as increasing FMCG growth. The consumer price index has been coming down, and the MNREGA jobs, it is also coming when people are shifting to people are exploring various private job opportunities, so that will boost this value segment. So these are all the past challenges, and I have just explained what are the steps taken by Bata to address these past challenges. Let's just look at our performance outlook. While the first half of FY25 for the footwear sector in India has been subdued, I am expecting a gradual recovery from the second half of FY25. I am expecting a single digit uh, revenue growth for FY25, but the EBITDA and PAT will, of course, decline. And once the sales start kicking in FY26 and 27, it will actually turn into a very good positive operating leverage, and expecting 11% revenue growth and a 27 percentage PAT growth for these 2 years. So my key considerations are while margin recovery is expected for FY26, the EBITDA margins will just be below historical levels. As you can see, my based on my forecast for FY26, the margins are 12%, which is lower than FY24. But after the sales and it turns into a positive operating leverage, the sales will continue to surpass this margin thing, past margin thing. And based on as we have seen in FY16 to 20, Bata has a 5% EBITDA margin expansion. So that have accelerated, that in turn translated into a good return on investor capital. Plus companies are focusing on asset light model, franchisee one franchisee operated model. So these two things will improve their ROC. So these are all the things that I wanted you guys to explain on how Beta has been in the past, and how it is going, how it is doing now, and how it will perform in the future. So that's it. I just explained everything about Beta and what they are doing and what they are doing and what they are going to do in the future. So we just have seen its company overview, their business model, their growth catalyst. Look at some charts on their products, their sales price, their brand positioning and management. In terms of management, prior to Beta, so what is his or her role in various global MNC giants, and we just looked at various investment thesis on Beta's growth, and how it is shifting in its operating model, and how the value segment has been affected, which is the larger contribution for Beta, and how Beta is effectively tackled this EBITDA margin. We did an EBITDA margin work on how various things has affected this thing, and we did a forecasting on revenue growth for Beta. We did the EBITDA margin work for the forecasting thing, and we did the working capital forecasting, and finally we did the cash flow things and arrived at certain return ratios. And finally, for valuation discussion, combining all these things, I have just this is what it is in the whole video. So that's it. That's what I have learned about Beta. So this is what I wanted to share with you guys. And thank you if you are still watching this video. Thank you for watching. Thank you for spending your time for my video. And before ending this video, I need to make some points clear again. Please do not make any investment decisions out of this. I will not be responsible for your losses. I'm just making this video uh, as part of my learning. It's a part of my learning. I just wanted to share with you guys. So that's it for this video. If you want to express your views on this video, or if you want a certain topic on which you want me to make a video on, just let me know in the comments. Thank you for watching. I'll see you again. Happy investing.